Welcome to Tech Money Madness Weekend Edition, your bite-sized investor education series. Today's topic, MACD, the momentum indicator every trader should know.
Yes, the infamous MACD. It is everywhere.
It really is. And I want to set the stage for our listeners today with a bit of a mental image. Imagine you are trying to steer a massive cargo ship,
Okay.
but you can only look at the wake behind you in the water. You can't see the horizon. You can't see the rocks ahead. You can literally only look at the churning water you just left behind to figure out your current speed and trajectory.
Wow. Yeah, that sounds like a terrible way to drive a boat.
Right. But that is essentially what millions of traders do every single day when they rely on the MACD. You are navigating the stock market by mathematically studying the trail left behind.
Yeah, that's exactly what it is. It's looking at the past to trade the future.
Which sounds completely counterintuitive, right, to base financial decisions on a rearview mirror. But pulling from sources like the CFA Institute, Investopedia, and Wikipedia, our mission for this deep dive is to demystify this incredibly famous tool.
It really is a foundational element. Like if you pull up any trading platform right now and load a standard layout, the top half is your price chart. And sitting right beneath that in its own little box is the MCD.
So what are we actually looking at when we see that box?
Well, visually, it looks like two lines chasing each other. They crisscross back and forth over a series of little vertical bars that grow above and below a zero line.
It was created by Gerald Appel, right?
Mm.
Back in the late 1970s.
Yes, exactly. And the reason it's still so ubiquitous today is because it measures four very distinct elements of a market trend all at once. It shows you the direction, the strength, the momentum, and the duration of a trend.
Okay, let's unpack this. I have to push back here. Why do we need three separate, complicated lines to just tell us if a stock is trending up or down? I mean, can't we just look at a simple price chart?
It's a fair question, but a simple price chart, it doesn't tell you if a trend is running out of steam. It just shows you where the car is right now. Right, so as the CFA Institute notes, MSE allows investors to identify potential buy and sell signals. Like, when the MACD line crosses above or below the signal line, that signals a shift in momentum long before the actual price chart makes it obvious.
So it's looking under the hood.
Exactly.
So let's talk about how it actually works. How do we get from a stock price to these lines? Because the name itself, Moving Average Convergence Divergence, is kind of a mouthful.
It is a mouthful, but it's literally the blueprint of the math. We are taking moving averages of a stock's past closing prices, and we're watching to see when those averages converge, getting closer together, or when they diverge, pulling apart.
But these aren't just simple averages, right?
No, they're exponential moving averages, or EMAs.
Right, and why is that distinction important? Because a moving average is just adding up the days and dividing, right?
Yeah. Well, a simple moving average works like that, yeah. But think about the flaw there. If you calculate a simple 26-day average, a massive, totally random price spike that happened 25 days ago carries the exact same mathematical weight as the price action from yesterday.
Oh, I see. So old data is skewing the current picture.
Exactly. An exponential moving average fixes that. It heavily weights the most recent days. So yesterday's closing price matters significantly more to the EMA than the price 3 weeks ago.
Which makes sense if you're trying to measure current momentum.
Precisely. That's why Gerald Appel used EMAs. They hug the recent price action much more tightly, so the indicator can detect shifts faster.
Okay, so let's get into the actual variables. The standard parameters that pretty much every trader uses are the 12, the 26, and the 9.
Right, those are the defaults.
So the 12-day is the short-term EMA. The 26-day is the long-term EMA. And that 9-day EMA acts as what we call the signal line.
Yeah, that's the setup.
So to make sure we don't lose anyone in the math, let's use a concrete example. How exactly do we calculate the main MACD line?
It is remarkably simple. You just subtract the 26-day EMA from the 12-day EMA. That's it. MACD equals EMA 12 minus EMA 26.
And then the signal line.
The signal line is just a 9-day EMA of that resulting XD line.
Okay, let's throw some actual numbers at this. Let's say the 12-day EMA of a stock is sitting at 50.
Okay.
And the 26-day EMA is at 40.
Right. So you subtract 40 from 50. That means your current MACD line value is a positive 10.
And if the 9-day EMA of that MACD line happens to be, say, 5, then your signal line is 5.
Exactly. You've got a MACD at 10 and a signal at 5.
Here's where it gets really interesting to me. It's almost like comparing a runner's recent sprint speed over the last 12 days to their overall marathon pace over the last 26 days.
Oh, I love that analogy, yes.
Because if the runner's sprint speed is faster than their marathon pace, you get a positive number. They're accelerating. But if they're exhausted and that 12-day sprint drops below the 26-day pace, you suddenly get a negative number.
Right, the momentum violently shifts downward.
But wait, I have to stop you here. If we are just subtracting one average from another average, aren't we just calculating old news?
Yes, absolutely, and I am so glad you asked that, because that exact mathematical reality leads us directly into the major limitations of this tool.
Okay, so we're talking about the pitfalls.
Yes. Because the MACD relies entirely on historical data, it is what we call a lagging indicator. It may not accurately reflect real-time market conditions.
So it's not predicting anything.
Not at all. It cannot predict what a stock will do tomorrow. It can only confirm what the momentum have been doing over the recent past.
Like looking at the wake of the boat.
Exactly like that. And this lag creates a huge vulnerability. Wikipedia points this out perfectly. The MACD is significantly less useful for stocks that are not actively trending.
You mean like when a stock is just bouncing around in a tight range, moving sideways?
Yeah, exactly. Choppy, sideways, unpredictable price action. Let's say a stock is stuck between $100 and $105 for a whole month. No real buyers, no real sellers, just a stalemate.
What happens to the math in that scenario?
Well, because the price is just bouncing in that tiny $5 window, the 12-day sprint pace and the 26-day marathon pace eventually catch up to each other. They converge.
So the difference between them becomes zero.
Right. The main MACD line flattens out right at the zero line. The signal line flattens out too. The whole indicator essentially flatlines.
But the market never stays perfectly flat.
Exactly. And that's the trap. Say there's a tiny, meaningless bump in price. It just blips up 50 cents. That little blip pulls the sensitive 12-day EMA up just enough to cause the MACD line to cross above the signal line.
So the indicator flashes a buy signal.
Yes, a false buy signal. A trader buys the stock, but there's no actual trend. The next day, it drops 50 cents, the MACD crosses back down, and it flashes a sell signal.
So you just bought high, sold low, and paid transaction fees.
Right. In the trading world, we call that getting whipsawed. And in a sideways market, that can happen 3 or 4 times in a month.
Which is incredibly frustrating.
Yep.
And I'm guessing that frustration leads traders to mess with the settings.
Oh, absolutely. And that is the parameter trap. The indicator is highly sensitive to the trader's choice of parameters.
So people go in and change the 12, 26, and 9.
All the time. A trader gets whipsawed, gets mad at the lag, and decides, hey, I'm going to change the 12-day to a 5-day and the 26-day to a 10-day. They think making it faster will help them catch the absolute bottom of a move.
But doesn't that just make it hypersensitive to every tiny ripple in the water?
Exactly. It amplifies the noise. You end up with dozens of false signals a week. And if you go the other way and widen the parameters, say 50 and 100 days, the lag gets so extreme that by the time you get a signal, the trend is already over.
So what does this all mean for the everyday investor listening right now? If this tool is lagging, sensitive to user error, and frankly useless in choppy markets, is it actually a crystal ball? Or is it more like looking at the wake of a boat to figure out where you are steering?
It is 100% the wake of the boat. And validating that is so important. The biggest misconception out there is that MACD is some standalone tool or crystal ball. It's never meant to be used that way.
So you have to pair it up.
Always. It is most powerful only when combined with other technical indicators. You need a complete, holistic view of the market. You pair it with volume analysis or the relative strength index. It's one instrument on the dashboard, not the entire car.
Right, that makes total sense. So let's distill all of this down into the key takeaways for our listeners today.
Sure.
First, MND is a technical tool used to identify changes in a stock's trend and its momentum.
Yeah, the convergence and divergence.
Second, the mechanics. It's built by subtracting a 26-day EMA from a 12-day EMA. Then you smooth that out with a 9-day signal line to generate your potential buy and sell triggers.
Spot on. And finally, the limitation. It is inherently a lagging indicator. You absolutely must pair it with other technical analysis tools to be effective.
So if someone wants to actually see this in action, where should they go?
I strongly encourage anyone listening to dive into visual resources. Technical analysis books, online investing courses, pull up your own trading account. Look at real stock charts, throw the MACD on there, and actually trace the lines, see where they cross.
Right, see what it looks like when a stock goes sideways versus when it shoots to the moon.
Exactly. The visual application makes the math instantly intuitive.
Before we wrap up, I want to pivot just a bit, because there's a fascinating historical context to those specific numbers. The 12, the 26, and the 9.
Oh yes, the 1970s market rhythm.
Right. Gerald Appel designed this in the late 70s. And back then, technical analysis often operated on the assumption of a 6-day trading week.
Yeah, which was common in global and commodity markets. So 12 days roughly meant 2 weeks. And 26 days roughly represented a full month of trading.
So it wasn't arbitrary. He was comparing 2-week momentum against a 1-month baseline.
Tied entirely to human behavioral cycles in an analog, phone-based trading world.
Which leaves us with a really provocative final thought for everyone listening. Today, we operate in a hyper-fast, algorithm-driven market. Millions of shares are traded in milliseconds.
News is priced in instantly.
Exactly. So, are those classic 1970s timeframes still the optimal default? Or is it time for a modern trader to rethink the speed of momentum entirely?
That is the ultimate question. Does the speed of the modern market demand a faster speedometer, or are human psychology and fear and greed still operating on a 2-week cycle? It's something every trader has to figure out for themselves.
That's all for this weekend's Deep Dive. Come back tomorrow for more investor education and weekdays for daily market coverage. Like, subscribe, and we'll see you next time on Tech Money Madness.